Well, the pressure valve for any free market economy is its currency. And for us, the rise or fall of our dollar affects the competitiveness of business, the price of goods and even the level of debt held by government, business and households. But as economic conditions now start to resemble the mid-1990s with big trade and current account deficits, the expectation is our dollar is at risk of a washout. Many forecasters suggest right now it should be back in the 50s against the US dollar. Now, right now you can see here live pictures. It's sitting at 62.29 US cents. Maybe part of the reason is that Donald Trump could push for an even weaker US dollar to make American manufacturing more competitive. Earlier, I spoke with currency expert Sean Callow from InTouch Capital Markets.
The peak years, it seems, for our trade position are behind us in terms of what we get for commodities in particular. And even if you look at our exports on the service side, then clearly international education is not going to be what it was before. So the export side is really cooling. And certainly when you look at the region and all the concerns over China, and they seem to be throwing the kitchen sink at it now, but certainly it's a gloomy outlook for the year ahead. And so the Aussies really struggled. It might be off its lows from a couple of weeks ago, but it's fallen a lot in recent months.
Okay, so we should explain this to people. Generally, the dollar comes under pressure when you've either got, more outflows from the country than what you've got money coming through the door. And as you point out, if you don't have lots of trade bringing money through the door, and if you've got a lot of interest going out on debts that governments have taken on, then that really is the recipe for the currency to fall. But technically, that also makes the country more competitive in the longer term as well.
Yeah, that's right. So we've certainly seen since the Aussie was floated back in 1983 by Paul Keating that it's been volatile at times, for sure. It's had times when it's been very strong. We remember above parity against the US dollar, and where it's been 50 cents or below. So it has the volatility, but the benefit of that, as you say, is that it can, when things are tough, you can have that currency depreciation that makes exporters more competitive overseas, and it means that domestic industry, when imports are more expensive because of that weaker currency, they can compete better against overseas imports. So that helps the domestic economy as well. So it really is that release valve for the economy.
The other thing that influences the rate of the Australian dollar is interest rates. And right now, if interest rates here remain higher for longer, or indeed don't fall in the same way that interest rates have fallen overseas, you would generally tend to think that would prop up the dollar. So there's a lot of moving parts here.
Yeah, absolutely. No, you see where the Aussie is strong against, say, the Japanese yen still, because the interest rates in Japan are still so low. They're only just starting to raise them from zero. So that's where you see an example of the Aussie interest rates being a lot more attractive. But against the US dollar, there's been that up and downs as far as those concerns over the Fed, whether inflation has fallen enough in the US for the Fed to keep cutting aggressively. So that's been something that's caused the US dollar to strengthen. About a month ago in particular, the Aussie fell very sharply after that Fed meeting back in December. So that's just a very fluid situation on the interest rate side. How attractive is Australia in terms of those yields? And obviously, we've got that meeting from the RBA next month, and the markets are not quite sure how that's going to pan out. It's about 70% priced in for a rate cut.
Just one aspect of this, for a government, and say, for example, Donald Trump right now, one thing to try and make America great again, which is his catch cry, would be to have a weaker US dollar to make US exports more competitive, and also to push up the price of imported goods from particularly China but other parts of the world. Is this something that a politician such as Trump has any real control over, though?
No, that's the key question, Ross, because it's a very difficult thing to control your currency, and particularly one that trades immense volumes every day, like the US dollar. So a lot of Trump's suggested policies, particularly on tariffs, they would act to reduce the demand for imports. I think that's where he'll be leaning, and that's actually has tended to support the US dollar. Also, if he's going to pursue aggressive tax cuts, if he doesn't achieve much in terms of spending cuts, then that might mean the economy runs a bit stronger, interest rates stay higher. And so the stronger dollar is certainly the consensus expectation from the market, and that's what we saw after the election in November. But I think it's just a bit too much for him to sort of have his cake and eat it to expect the US dollar to soften.
And Sean, what's your own forecast for where the Aussie dollar is going to be over the next 12 months?
Look, I think near term, the risks are certainly lower as we absorb the new Trump administration's trade policy. So I think 60 cents or below is where we'll probe in the first half of the year. Perhaps by the end of the year, it could start to stabilise, although that would require some better numbers from China. So maybe you get back to the low 60s by year end.
I'll tell you what, Sean Callow from InTouch Capital Markets. Good to have you on the program today, Sean. Many thanks for your time.